All right, so we're about to start 2026. You've probably seen a lot of headlines about short-term rentals, Airbnbs over the last 4 or 5 years. But if you're here, it's because you're curious and you're interested in starting a short-term rental business in 2026. I have owned short-term vacation rentals for over 10 years, so I've seen the ups, the downs, several economic cycles, so I've seen a lot. And let me tell you, there's still plenty of opportunity for you to start a short-term rental business in 2026. Congratulations for being here, first of all. Done right, this business can be life-changing. It's changed my life for the better, but here's the truth. It's not as simple as just buying any old house and throwing a bunch of mama furniture in there and waiting for the 5-star reviews to roll in. That's not real life. You are not going to be successful that way. So I've made a lot of mistakes over the last 10 years, but I've done a lot of things right. And I'm here to keep you from making the same mistakes that I made. So let's break down the 7 things that you need to nail in 2026 to be successful at starting your short-term rental business. So step number 1 is to get real about your budget. Before you look at properties, before you start cruising Zillow, you need to know how much you can actually spend on this property, how much you can comfortably afford. In 2026, interest rates are still gonna be relatively high, insurance costs are rising, and you need to build an extra cushion or cash reserves for hidden expenses. So furniture, utilities, crazy things that pop up with guests, unpredictability, that stuff is always gonna show up. So pro tip here on this one, don't automatically spend that max amount that you can afford with a loan pre-approval. Dial that back a little bit so that you have plenty of reserves for any of those surprises that may pop up. Number 1 is a little bit of a shorter tip. Number 2, a little bit longer. Choose the right financing strategy. There are different types of loans that you can get for short-term rental investing, and you need to be familiar with all of them. So before you buy, you need to decide whether you're gonna use a conventional loan, a DSCR loan, or a commercial loan. Now, why does this matter? Because at some point, you're probably gonna want an LLC for your properties, and your loan choice affects whether you can buy in your LLC or if you have to convert into an LLC later. Quick disclaimer, I'm not an attorney or a CPA, so talk to yours before implementing any of the advice that you get on the internet, because it's worth about what you're paying for it. I'm not a professional, I can just give you my opinions. So let's first talk about conventional loans. So conventional loans are gonna be the easiest to find. You can walk into any bank or mortgage brokerage in the country and find a conventional investment loan. It will need to be an investment loan. You cannot use a primary home loan to buy an investment property. That is mortgage fraud. With conventional loans, they are tied to your personal name. So you cannot get a conventional loan in an LLC. But what's good about conventional loans, they typically have lower interest rates and lower down payments. So 15% down is actually the minimum percent down that you can put for a conventional investment loan. A lot of people mistakenly think it's 20 or 25%, but it's actually 15. Conventional loans also are given to you based on your own debt to income ratio. So you're gonna be limited by your income and the amount of debt that you have. So there's some pros to those conventional loans, the fact that they're easy to find and that the rates are typically better and down payments are a little bit lower, but you're gonna be limited on your own debt to income ratio, so keep that in mind. So the second most common type of loans that short-term rental investors get for their properties are DSCR loans. That stands for debt service coverage ratio. Now, these are popular because you are not limited to your debt to income ratio, so you're not qualified based on what you make and your debt. You're qualified for these types of loans based on what the property will make. That makes them really popular with investors. You can also buy them in your LLC. Makes that process a little bit more smooth. But be aware though, lenders will often want to see some experience with short-term rentals before they'll give you this type of loan. So that can be a little bit of a catch-22. Also, DSCR loans, typically you have to put 20% down or more. And if this sounds too good to be true, just know the banks and lenders are gonna make their money somewhere, and typically it's gonna be on the interest rate. So DSCR loans have a much higher interest rate than a conventional investment loan. So the key for you getting started is to decide upfront what type of financing fits your situation and your long-term structure. If you're brand new, conventional might be easier to get started with. If you're more established, then DSCR or commercial loans might give you a little bit more flexibility. Step number 3, this is probably the most important step, is pick your market with intention. So don't read some list on the internet. Don't pay somebody $20,000 to tell you where to buy. You can use that $20,000 for your down payment and do your own research. So the most important thing to know when you're choosing your market, the most important thing, guys, most important is regulations. Know what is allowed and not allowed when it comes to short-term rentals. in your market? Are the regulations established and friendly? You want a market with clear, stable rules. You don't want a market where everything's kind of still in flux and they're trying to decide. And you don't want a city that's still trying to figure it out, constantly changing the rules or threatening to ban short-term rentals altogether. This is not good. You don't want to buy something and then be told next year that you can't use your property for its originally intended use. So make sure you're choosing a market where the regulations are very, very stable and clear. I have seen very experienced investors totally screw this up and then post about it on the internet later, that they did not check what the licensing requirements were until after they closed on a property, and then they were not able to short-term rent that property. So how do you find out what the regulations are? You personally, you yourself, not your agent, not your property manager, not some random asshole on Facebook, you call the city or county directly and find out what the regulations are. If you're inside city limits, you call the city. Outside city limits, you call the county. And not only ask them what the current regulations are, but what's being discussed in city council meetings, what looks like it's coming down the pipe. The best way for you to make the right decision is to get the information directly from the horse's mouth. A lot can get lost in translation if anyone calls for you. So make sure you're always making that phone call directly. Once you've confirmed that the short-term rental regulations in your chosen market are favorable, you need to make sure that you're buying in a market where you have a competitive edge. Well, if you're like, I don't have any properties yet, how do I have a competitive edge? Your competitive edge is always going to be your knowledge of your market. It doesn't necessarily have to be where you live. As a matter of fact, I don't recommend investing where you live unless you live in a true vacation market. We're going to talk about that later in the video, but somewhere you've been as a tourist, somewhere where you understand why tourists go there, what they want to rent, what they're coming to visit, what time of year they come, and just putting yourself in the place of your guest avatar. Having that local knowledge is not replaceable by any spreadsheet whatsoever. So let's look at a quick example. I'm from Starkville, Mississippi. It's a very small town in North Mississippi. There's only one thing there, only one thing that people come to do, and that is the worst football team in the SEC, Mississippi State. Sorry, Dad. And I grew up in Starkville. I could be really successful in Starkville because I know exactly who's coming there, why they're coming there, what time of year. There's probably not a lot of vacation rental cleaners or really infrastructure in Starkville, but that's okay because I know enough people there that I can train someone to do what I need them to do. Now, if I were to look into Starkville and find that they had unfavorable short-term rental regulations, then what I would do is pivot to the next closest thing that's very similar. So let's look at other SEC towns within a 2-hour radius. So we have Tuscaloosa, where University of Alabama is, and we have Oxford, Mississippi, where Ole Miss is. So if Starkville didn't work, well, these are also two small towns that only have SEC schools in terms of industry. So the tourism is going to be very, very similar. So I would feel totally comfortable pivoting from Starkville to Tuscaloosa or Oxford if the regulations were more favorable in one of those two areas. Now, let me tell you though what my personal preference is in terms of types of markets to invest. I probably would not buy a game day rental in Starkville. Game day rentals can be great investments. I'm not saying don't do that, but to me, true vacation rental markets, places where the entire economy revolves around tourism, think beach towns, lake towns, mountain towns, national park towns, places where people have been renting vacation homes overnight long before Airbnb existed, even before the internet existed in a lot of cases. These types of markets where short-term rentals are not new and they're baked into the local culture. So a lot of people will say that true vacation rental markets are saturated. Guess what? In 2026, let's assume that every single market in the country is saturated. Forget that word. Saturation is an excuse. Competition is motivation. If a market is full of short-term rentals, that actually tells me a few really good things. Number one, that the regulations are friendly and well established. Number two, that there's enough tourism demand to support that many vacation rentals existing. And number three, that the infrastructure is there in terms of vendors for short-term rental owners. So cleaners, handymen, services that you'll need to run your short-term rental business remotely. For example, I live in a little area of Florida called 30A. This is a very vacation rental driven town. There are only 10,000 of us who live here full time, and all of the jobs are related to tourism, vacation rental support, or real estate sales. There's no industry outside of that whatsoever. As a matter of fact, a lot of restaurants and other businesses close from November until March. That being said, 10 million people come visit our beaches every single summer, and they're all staying in vacation rentals. So that's the lifeblood of our local economy, and it makes running a short-term rental business much easier. Is there a lot of competition? Yes. But it's really not that difficult if you buy right, finance right, and manage right to do better than most of that competition and be in that at least 75th percentile of AirDNA. Let's compare that to trying to trailblaze in a market where short-term rentals are not common. So I've seen this theme up until now. Between 2022 and 2025, a lot of people have said, oh, I want to buy where there's no short-term rentals. I'm going to be the first short-term rental investor in this market. I'm going to buy where no short-term rental investor has gone before because saturation is the enemy. So if you're brand new, you don't want to be learning to manage a short-term rental in a place where there's no support, no infrastructure. You're going to have to train a cleaner who cleans primary homes on how to turn a vacation rental, which is a completely different process. You want to be able to plug into a system that's already there that works. So that's why true vacation rental markets are my favorite go-to type of market. Okay, that was a long-winded one. Let's get to step number 4. Learning to analyze a property and lock in a property that stands out. So before you buy, you've got to learn to analyze properties yourself. Don't outsource this. There's plenty of services that will do this for you, but if you don't learn to do this, you are going to fail. If you can't analyze a property, you have no business being a real estate investor. You're going to sell your property in 2 years, just like 50% of everybody who buys a real estate investment. Analyze your own properties. Learn how to do this. I'm about to show you how. So in order to analyze effectively, you need as many data points as you can get, which means the seller's rental history is not good enough. It's just one data point, and honestly, it's not even the most important one. Their history is in no way an indication of future performance. You have to ask a lot more questions than just what's the rental history. You need to know who's managing it. Is it a big rental company? How many units do they manage? A lot of those high volume rental companies have like thousands of units, and their goal is not to optimize and get you the highest price per night for your property. Their goal is to get a lot of low price bookings, volume across multiple thousands of properties, low prices, asses in the seats to get those things booked. They split those small numbers with the property owners, and then they hike up big fees on the end of those because a lot of them are doing mostly direct bookings. So their history is going to be garbage. And on the flip side of that, whoever's managing it might be the biggest rock star manager there ever was, and you may have no chance of hitting the numbers that they're hitting. So you need multiple data sources when it comes to short-term rental analysis, not just the rental history. As a matter of fact, I would say rental history is the least important data source. So here's an example from my own portfolio. I bought a property back in 2017 that was doing $23,000 a year with the current manager. I underwrote that property to do about $35,000 a year. Our very first year we owned it, we did $45,000 a year. At the height of COVID, that same property did $90,000. The last 3 years, 2023 to 2025, that property has done between $74,000 and $78,000 a year. If I had dismissed that property because the old owner's rental history sucked, I'd be a lot poorer than I am today. All that to say, yes, rental history does matter, but it's just a single piece of the puzzle. You need as many data points as possible. Some of my go-tos are AirDNA, a solid starting point, and if you look at their most recent annual market update, it's clear that the short-term rental market has stabilized, yet things spiked during COVID and dropped off hard. So now performance though is much more predictable than it used to be. It has leveled out. We're now in a stabilized market. So anyway, AirDNA, good option. Airbnb, another great tool. Rabu, another one. We need to be using all of these, by the way. But my very favorite is the Price Labs market dashboards because you can draw your own perimeter around the property that you're looking to analyze. So with AirDNA, you're just looking at the entire market. It's a preset perimeter. But with Price Labs, you can go draw a little circle and draw it in freehand of the area that you want to analyze and look at the income from. So that helps a lot because different areas of town that have different proximity to the attractions are probably going to perform better than others. So you want to be able to kind of carve that out for yourself. So once you pulled in data from multiple sources and built a realistic range of what a property should be able to do, then it's time to use what we at the Short Term Shop call the enemy method. Here's how it works. You log into Airbnb or Vrbo just as a guest would, search the exact area where your property is going to be, and look at the competition. Look at the other properties that guests are going to be presented with when they're presented with yours. You want to look at what do the top performers have that your property doesn't have? What can you add to match or beat them? And what advantages does the property that you're looking at already have that theirs doesn't? For example, views, water access, location, privacy, things like that. Don't just look at the amenities like hot tubs or or decor, look at the fundamentals and be honest with yourself. If a 4-bedroom nearby is crushing it, figure out why. Is it because they've got features that you can't possibly compete with, like, I don't know, a private chef and a helicopter? Well, they're gonna be making more money than you because it's my guess you're not going to be offering those amenities. So set realistic expectations. Don't just look at a property that is clearly superior to yours and say, oh, I'll make that much because I'm gonna manage well. Be realistic about the other similar properties, similar being the key word, in your research. On the flip side of that, again, if you're looking at 4 bedrooms and the 4-bedroom next door to you is doing terrible, look at why it's doing terrible. Are the pictures really blurry? Is the paint peeling off? Does it look like somewhere that people don't want to stay? Well, that's probably why it's doing terrible. So if you are looking at a cute, clean, comfortable, nice, updated property, you can assume or infer that your property is probably going to do better than that one because just aesthetically, it is a better property. So there can be outliers in either direction. That's why you need to look at as many data sources as possible, as well as the enemy method to see why the data says what it says. So the data is the what, the enemy method is the why behind that data. Part of analyzing is doing the appropriate amount of research on your market. Be very cautious of companies that say, pay us tens of thousands of dollars and we'll find you the best short-term rental in the whole country in 30 days. That's not real life, and that is not due diligence. If you want to be successful in this business, you have to know what to look for yourself. The fastest way to fail as an investor, or really any business, is to let other people do everything for you from the beginning. You have to understand how to evaluate markets and properties. This is your investment. This is your future. And to quote Elvis Presley, it is your baby, you rock it. Bottom line on step 4, combine multiple data services, competitor analysis, and your own due diligence. And the good news is in 2026, the short-term rental market is more stable and predictable than it has been in the last 4 or 5 years. And that means your analysis will be more accurate than ever if you do it right. Step number 5, design and furnishing for success. So when it comes to design and furnishing, the goal is not to win at Instagram, it's to win bookings. So you want your property to photograph well, of course. You want it to be cute, clean, comfortable, updated, and sparkling clean. Guests don't need over-the-top immersive decor. They just want a space that feels fresh, inviting, and easy to live in. Will you get clicks and views if you have crazy over-the-top amenities and immersive theming? Yes. But what's most important to guests is the value they feel they're getting for the property. I'm not saying cheap, I'm saying value. So make sure that your value is in line with what your target demographic in your market is looking for. So here's the big hack that I mentioned in the title of this video. It's very expensive to furnish a vacation rental from the ground up. A lot of people think that they're gonna have to do that no matter what when they get into the short-term rental space. However, if you're buying in a true vacation market, so like Destin, the Smoky Mountains, places like that, most properties in these areas are already short-term rentals or they're already somebody's second home, which means oftentimes they're gonna come fully furnished all the way down to the silverware. So that can save you a massive amount of money on startup costs to buy in a market like this because you're not having to furnish from the ground up. You're just gonna refresh what's already there. Now let's talk about some more things to avoid. Again, be very careful of the property finding services that give you case studies that say, my client bought this property for $500,000 and it's making $200,000 a year. Here's the problem with this. A lot of times when they're making these case study pitches, they're telling you how much the base cost of the property was. They're not telling you that $500,000 property cost $300,000 to $400,000 in amenities and upgrades in order to hit that $200,000 a year. You better have that $500,000 down payment, $100,000 plus another $300,000 or $400,000 cash to make those updates. So it stops making as much sense at that point. To me, that $300,000 or $400,000 in upgrade money could be better spent on buying more pieces of real estate. Real estate is an appreciating asset. When you buy a $500,000 house and put $400,000 worth of amenities, you're maybe boosting that value of that house to $650,000. You do not now have a $900,000 house. So for me, I'd rather spend that $400,000 cash that you could be spending on these amenities in buying more appreciating assets that will cash flow. So for me, I like my properties to be cute, clean, comfortable, and very nicely updated, but I'm not going overboard with filling up the entire backyard with all these crazy things because I want to use that $400,000 that I would be spending on these amenities in order to buy more real estate and grow my wealth more quickly. So to wrap up this point, keep it simple. Cute, clean, comfortable. That's what guests actually want, ties into that value piece. And if you need design help, there are a lot of excellent independent short-term rental design companies out there who you can hire. You don't have to burn through hundreds of thousands of dollars to compete. Step number 6, build a rock solid operations plan. This is where the money is made or lost. Whether you self-manage, hire help, you need to have a reliable cleaning team, a handy person that you can call on short notice, actually a list of handy people that you can call on short notice, property management software like Hospitable, Price Labs to automate messages, dynamic pricing, and guest experience touches. So guys, your cleaners and vendors are the lifeline of your business. You need to treat them like gold because they are. Pay them on time and don't skimp. Guests will let you know in the reviews if you try to cut corners. And here's the thing, if you really want to scale and stay profitable, you have to build what's called SOPs, or standard operating procedures, so that everything runs smoothly even when you're not there. So 2 resources that I have to help you do this are my second book, Smarter Short-Term Rentals, How to Outhost the Competition, which goes deep onto building systems and automating and scaling your business like a pro. We also have Short-Term Shop Plus, which is our community and mentorship platform. We give you hands-on training, templates, and tools for creating SOPs that actually work in the real world. And the good news is it does not cost tens of thousands of dollars. It actually costs less than $1,000. We try to make it affordable for everyone because we feel like everybody deserves to be able to learn how to run their business effectively. Operations are not glamorous by any means, but they're what separates struggling hosts from successful investors. Nail this and you nail the business that's scalable and sustainable. Step number 7, obsess over the guest experience. In 2026, guests expect more than just a place to sleep. They expect a fully stocked house. That means cohesive decor, comfortable furniture, and every amenity they could possibly need for their stay. They shouldn't have to ask for a thing. Your digital guidebook should answer every question before they even think to ask it. I use TouchStay personally for my digital guidebook. They need to know how to work the thermostat, where to find extra towels, how to use the coffee maker. All of that should be in your digital guidebook so they never have to ask. And speaking of things like coffee makers, electronics, appliances, make sure that everything you have in your house is simple and intuitive. You don't want complicated thermostats, things like that people have a hard time working, so then they have to message you and then they get annoyed, can lead to bad reviews. If guests can't figure out how to use it, you've already failed. Everything needs to be 1000% sparkling clean every time. And on top of that, you personally need to be responsive and hospitable, and don't take negative feedback personally. Quick replies and a helpful attitude go a very long way. And don't get snarky even if your guest does. Bottom line again, make your property easy, comfortable, and stress-free. The smoother the guest experience, the more 5-star reviews you're gonna get, and those reviews are gonna drive up your rankings, occupancy, and of course, your revenue. Starting a short-term rental in 2026 is not easy, but if you plan smart, manage well, and you focus on the guest experience, it can be incredibly rewarding. Stick to these 7 steps and you'll be well on your way to creating not just another rental, but a profitable short-term rental business that you can scale and grow that generational wealth that you're looking for. Did you find any of this helpful? Drop me a comment below, like and subscribe so I can create more videos, and thank you guys so much for watching.